Hey everyone, it's Imran from Options Insight with your macro options spotlight. Remember, like, subscribe, comment, ask questions, do whatever you like, but we want to get the algorithm passing this around so people can learn about options and learn this information. Okay, so spot gave back an early rally. So first trading day of the year for the US. It did pop and then got faded pretty damn fast as stocks like Tesla and Apple rolled over concerns. China data, obviously, as well, raised growth concerns. Apple potentially missing some orders out of Asia that they were expecting, and then Tesla delivery data looking pretty poor. So that was down 12% by the end of the day. Europe did manage to hold on to some gains, though, as inflation data in Germany cooled more than expected. And then China stocks were also firmer on reports of them supporting some of the too big to fail property developers, supporting the market there. Commodities outside of precious metals, though, got a bit hammered. Really, the energy space taking the brunt there. Natural gas down 10%, oil down 3.5% as well. China growth fears being touted as the big thing for oil, and then also natural gas falling off a cliff after it broke those key supports. Vol-wise, we did see a pop on the 1 month vol in S&P. Now that's a bit of a technical thing because the 1 month maturity now captures the FOMC meeting at the start of February. So it's not like some massive bid to vol where everyone's buying options necessarily. It's just that 1 month compared to when the market was last open, that actual date didn't include the key FOMC meeting. And so that's worth a little bit more in terms of vol. So that's why the vols that those options trade at about 2 vols higher. Outside of that, European vols got hit back down. You can see there giving back 70 basis points. So that bid in vol that we saw on the first day of the year got faded pretty damn fast. And then commodity vols, you can see in the green across the board, with the biggest outlier, this 4 vol spike in oil vol, as oil taking out those supports to the downside again. We thought oil was maybe, starting to put in a bit of bullish momentum again with the strong performance into year end, but didn't take long for that to fade, basically. So there you go. Looking at carry, pretty mixed on the equity side. Got positive carry in the US, pretty mixed everywhere else. But European vols actually starting to look relatively decent value here. And then in terms of commodities, generally green, silver moving, everything else pretty much positive carry, with copper the best at 50% positive. So copper definitely trading a bit more range bound than most of the other commodities right now. In terms of skew, equity skew still on the low side, as it has been for many months. FTSE skew probably the cheapest there on a percentile basis. And the natural gas skew in commodities is probably the most interesting, looking pretty extreme here. And when I say extreme, generally natural gas skew trades for calls, and here it's only 3 vols for calls. So it's about as flat as you've ever seen the natural gas skew in a long time. And that's because natural gas obviously been tanking to the downside, and people don't really want to buy calls anymore. So they're more concerned about the downside move because we don't know where the bottom is in this thing. Okay, so that's kind of it for equities and commodities. Now, the big things that were really driving the weakness, as we mentioned yesterday, were Apple and Tesla. So those stocks obviously have been, big bellwethers for the market. Tesla was down 12%, missing their delivery estimates, giving back that counter trend bounce that we had talked about. People thinking Tesla was a bit oversold in the short term, down to 100, managed to bounce to 125 in a matter of days, but now it's given it all back. So not really managing to hold on to any of those gains. So maybe a bounce to 150 might be a little bit too much for Tesla to manage. And then Apple was holding on to that 130 support level over the holiday period, but that finally broke. So Apple accelerated to the downside, struggling there. People are now calling for potentially as low as $100 for Apple. And if that was to happen, then that's going to spell trouble for the S&P, because that's the last remaining bellwether FANG stock that managed to actually do okay, whereas the rest of the FANGs got hit pretty hard over the last couple of earnings quarters. Apple has been hanging on there. And if that really technically is breaking down, then it's going to be hard for the S&P to put in any gains in the short term. So that's kind of what we're looking at. Those 2 big tech stocks really driving things right now and driving sentiment. And then the last thing to talk about really is yields. In terms of yesterday, yields having that strong move lower on the weaker China data and the lower German inflation. We've obviously got US ISM today. We've got manufacturing, we've got the manufacturing PMI. We've also got Fed minutes. So what's that going to do to the US yield curve? And is it going to give us any clues for what the market thinks about the state of the economy going forward? into 2023. So those are the main things to watch out for. In terms of opportunities and what I'm seeing in vol space. So looking at my sort of where I compare the equity indices and the volatilities there, the kind of standout really is the FTSE right now. So you can see here we've got on the lowest of all of these in the strategy compass is the blue one, which is UKX, which is a FTSE index. And if we look at the realized vol of the FTSE, it seems to be putting in a little bit of a floor at around 9 to 10 vols. Okay. Now, the interesting thing is the implied vol is 12.5, and it's the lowest by far, apart from Nifty, which is the Indian index. But in terms of Europe and the US, it's the lowest by far. And the spread between the FTSE vol and the rest of those indices is pretty wide in terms of where it normally would trade. So we do think the FTSE is offering some value in terms of vols, because we don't really see realized going much below 10 vols here on a 30-day basis. And we don't think that spread's too big between 10 and 2.5 vols. Now, the strategy compass is saying to buy puts. We think that's a bit risky buying puts. We think buying straddles probably makes more sense because it could break to the upside. If you look at the chart on FTSE, it's kind of hitting a resistance level that's kind of capped it for the whole of last year. And if it was to take that out, it could easily do a couple of 100 points to the upside. So we actually think it's more likely that we get a move from here rather than just a down move, which would be the mean reversion of the latest rally. Now, for people who've got more conviction shorting the FTSE up here, and if you're particularly bearish or you're looking for ways to get short, then buying puts doesn't look bad. We're just talking a bit about energy complex. Obviously, commodities had a decent run into the end of the year, except for natural gas. We look at the natural gas chart, you can see the big level for us was this kind of $5 level here. And when that broke, we got the hell out of Dodge. And it's done a quick 20%. And we think the next major support is kind of around 3.5 here. So we're not stepping in to buy any natural gas. Clearly, it's very much driven by the weather, and it's been a lot warmer weather both in the US and in Europe. So we're not really going to try and fade that because we've got zero edge in calling the weather. And then outside of natural gas, oil had a bad day, like we said yesterday. It was driven by these kind of gasoline and diesel prices. So you can see the losses in gasoline and diesel were worse than crude. So generally, that's not a good thing for the market when these things are in the driving seat. Excuse the pun. But anyway, we do think these crack spreads are relatively well supported. We don't think they're just going to fall out of bed. We do think the physical market, there is tightness there. There's underlying structural tightness. And we think that is going to play a part. And we also think that if demand continues to roll over and we do see a massive demand reduction on the back of global recession, well, OPEC's just going to respond to that by cutting production. Okay, so we definitely think fundamentally the case for oil looks stronger than the case for natural gas. So if we are going to put long deltas on in commodities, we're going to do them in things like oil, the commodity itself, or we're going to look at XLE, which gives us exposure to some of these refiners and things like that, and some of these oil companies that we think in general will trade better than the commodity, just like they did last year. We think that's probably going to continue. So looking for dips to buy those things and get into those things using things like call spreads is probably going to make sense at some point if this thing continues to dip. All right, that's it for today. Thanks a lot for listening, and I'll catch you all tomorrow.